Comparisons are often made to the peaks and valuations in past markets, especially looking at the peak in 2000 for the stock market. They always say no way it's anything like 2000 because the dot-com bubble had, some PEs that were just extraordinary, 100, 200 PEs on some of these tech stocks. So it's pretty tough to make a comparison about that. So, and there's been, I'm changing the subject a little bit. There's been a lot of talk around about income inequality, and that's kind of died down also. Well, I'm going to talk a little bit about what the income inequality actually looks like when you compare what's happened to the stock market to, well, the affordability compared to what the average person on Main Street could buy. Business Insider just did an article, and I showed actually a chart similar to this some months ago where I talked about the valuations of stocks relative to the common man out there. Fed and all the central banks, well, they acted in ways to save the world. And asset prices, well, they shoved them up, right? And we still see that going on. And they bailed out the banks, and they just, printed all kinds of money so that they could, save what was a world that was obviously coming apart. I won't make any comment about the moral hazard about that, but all that happened. Asset prices went up, all-time highs right now, and Main Street got pretty much left behind. In fact, they're burdened by massive amounts of debt, and we're seeing that in the consumer. The ability for consumers to buy, retail sales very weak, and consumer prices weak, and so they're burdened, really burdened by a huge amount of debt. And the Fed wanted that, and they wanted everybody to take on debt. That's the Keynesian way, in order to save the problem that they actually created. Here now is that was the lead up to a picture, a graphic that I'm going to show you right in here, and thanks to Merrill Lynch for putting this out, Bank of America Merrill Lynch, and Business Insider for sharing the graphic, and here you go. So what I want you to see in here, which I think is pretty significant, is that you have a valuation based on the amount of hours it takes for a person to work to buy a unit of the S&P 500. Here is that high in 2000 right there where we had that dot-com bubble, and here's the comparison right over here. That's because, well, middle class is so emburdened by the debt that the Fed wanted them to take on, and that is a picture that is I would say telling you that valuations, if you want to compare them to 2000, well, the stock market is very high when you look at that. What I want you to do is think about this consumer and the fact that they're so burdened. Think about the economy and that it's been 8 years of sub 2% growth, and that's with a zero interest rate policy, ZIRP. That's all they could get. Think of record low cash in the hands of fund managers, down to 2.4%. And the cash managers, the fund managers, well, they've been thrashing in here. There's been this rotation going on. Yeah, we're edging out to a new high right now. But the stock market, as you can see, based on this level of valuation, is incredible. Think about bear markets. The Fed thinks that they have banished them, essentially, through their miraculous work to save the world. Yet, I've been at this 43 years. I started trading in 1974 on the CBOE. I have traded 8 bear markets. I've traded 3-4 crashes in the middle of those bear markets. That's 1978 crash, 1979 mini crash, 1987. So believe me, they did not banish bear markets. It's the illusion that they have, and the Fed wants you to think that. I mean, that's part of their mental game that they play to try to save the markets. Well, what do you think? I hope you enjoyed that video. Be sure to subscribe to our YouTube channel and also go to askSlim.com and become a Level 1 member. No cost to you, and we have some special videos for you to see. I know you'll enjoy it.